Hello everyone, good morning. Yesterday I made a video and unfortunately one of the videos they had a problem with the screen sharing. So I'm just going to start all over again and take everything I took in the first part of yesterday's video. So we are going to be looking at the four elements of a trade setup, and like I said yesterday, when you are just finding yourself in the forex trading space, the first thing you always get to learn is how to read the market structure. And today, I'm going to be sharing some things with you on how to do that the very best way without having to rely on some trading indicators or some trading tools that are really not necessary. Here, you are going to be learning the exact art of market structure analysis, and we'll be building your foundation in the four elements to a trade setup. So the first one we'll be looking at is expansion, and the definition says expansion is the fast price movement away from a level of equilibrium. From our first week, I explained what dealing range is and what equilibrium also is. And if you can look at the screen here, you can see we have you know this area I have shaded gray, and inside that area we can see we do not have a trending market. That is, a downtrend is a market that goes down, and an uptrend is a market that goes up. So we can't say we have any of those two inside this shaded area. Instead, we have a market that is not going up or going down. So we can assume that this market is a sideway market, in other words, a consolidating market. But here, this is not what we want to know. So inside this gray area, we can find a high to be there, and we can also find a low to be here, right? And this highest high and lowest low gives us a range inside the sideway market. And as after getting that, we can get the 50% of that range to be the equilibrium. I can say 50% of the range is our equilibrium. So from the definition of expansion, it is a fast price movement from equilibrium. Now, you can see price, came back into equilibrium and then aggressively pushed up from there inside this green shaded area. That green shaded area is price expansion. Now, price can also or either expand from the towards the right side or the wrong side. And what I mean by that is price can expand in the wrong direction to induce traders to want to take a trade in the wrong direction, or it can expand in the direction it is meant to go. How would you know the difference? Well, when we get to power of three, we are going to know the difference. So for now, I expect that you understand that expansion is when price goes back into a range. Not sorry, expansion is not when. Expansion is when price leaves a range. Okay. Retracement is when price goes back into a range. And what is the range? The range is your dealing range at any point, at any during any time frame or any time of day or session of day. So expansion here is the fact that price left equilibrium. Sometimes, this movement into equilibrium can even go below equilibrium, known as either discount or premium. When price retraces back into your discount or premium, it gives a deep impression like this. So from here, price leaving this area and moving aggressively fast from that range equals to price expansion. Okay. So the second one we want to look at is retracement. What does it mean when price retrace? It's the same, but now price isn't leaving your equilibrium, but price is moving into or going towards equilibrium after creating a range. So from the definition we have here, we have it that price moves back into the recently created dealing range. So at any point where you have a range, that is price has formed a high and a low, then from our lesson on corrective impulse and corrective waves, the corrective waves are usually the retracement. So impulse is when price creates that expansion, that range. Then the retracement is when price goes back for a corrective wave into the range. I don't want to confuse you, but what we do have here is you can see that from the equilibrium of this range, price expanded. This is an expansion. Then left, created a high and came back into the range. This coming back from the high down to equilibrium is your retracement. Now, it can be this is retracement, expansion, retracement, expansion, retracement, expansion. That is how it works. So, price leaving this, look at the arrow here, area, immediately leaves, it expands. That is expansion. Coming back, retracement. You know, this is an expansion, this is a retracement, this is an expansion, this is a retracement, expansion, retracement, and so on and so forth. So it can be in an uptrend and it can also be in a downtrend. So uptrend is when the market creates higher highs and higher lows and goes up. Downtrend is when market creates lower lows and lower highs. And what we have here, you can see we have a uptrend here and we have a downtrend right here. So things to consider when you're looking at retracement, you have to consider the market structure. That is, you have to know where the swing high is and where the swing low also is. You have to also understand fresh highs and fresh lows. The same thing as looking at the market structure. Also looking at market structure, you have to find where the break of structure is. As price created a new high, do we have a failed swing and so on and so forth. Okay, so we'll leave the remaining two for now because we are yet to get to those. So we have three major types of retracement. You can either have a deep retracement, a shallow, or an optimum trade entry. Now, shallow retracement is when you have a dealing range and then price comes to, let's say, less than 50%. Okay, less than 50% of the retracement. That is shallow, meaning it's not that far. Deep retracement is when you have price come to somewhere around 50% equilibrium of your range. And deep um, OTE is if it goes below 50% of the range. If you don't understand, don't worry. As we take some examples, you are going to understand. So, retracement continue. We will see that this is a downtrend now compared to the uptrend we did. And you can see here that we have a swing high, a swing low, right? And a retracement. After the retracement comes what? An expansion. After an expansion comes another retracement back up, then an expansion down to the other side. Also, we can say this is a distribution. So as we advance, we will start talking about distribution and also redistribution as well. Okay, so this is a downtrend, and you can already see if we plot a Fibonacci 2, we are going to see that this retrace to about equilibrium, which is 50% retracement. And if you take this high, this is a swing high, and this is also the swing low. So this is a swing high. So ability to identify correct swing point is also very necessary, and you can only be able to get good at it if you practice. So if you look at this swing high to this swing low, we have a retracement, and I can tell that this retracement went above probably 50%. So that can be said to be a deep retracement or even OTE, not a shallow retracement. So the one that retraces below 50% of the range can be said to be shallow. Then from there we have it, spike down. So retracement part two. The question is, why does price always have to retrace? Well, I've already explained, I think last week during the impulse and corrective wave lesson, that the market won't just go down and go up and come down. No, it has to do it in a manner that it gives chance or gives room for fair pricing. What is fair pricing? Fair pricing means if price just runs down, inside that run, there will be a lot of inefficiencies, there will be a lot of gaps, voids that were not probably properly traded. And price would always want to go back into those areas so that traders, market makers can stack up more short position in the case of a downtrend now. As price goes back up, they take more shots, and then when price reaches the point of threshold, it spikes back down for profits or loss, depending on what direction you are. So price would always raise for this simple reason. Look at this now. Look at these massive down close candles. They created inefficiency. The price was not, you know, efficiently traded. And that is why you would have price retrace for efficient price delivery. Higher time frames market structure, lower time frame market structure, they are the same. Whatever market structure analysis you can apply on daily, you can also apply it on the 1 minute time frame. It is the same algorithm operating all these time frames and putting all of them together. So you can measure retracement using the Fibonacci tool, which we'll be explaining later. Also, shift of market structure, break of market structure, and finding your range. You already know how to find your range based on our discount and premium analysis. So, break of structure, I will be explaining it in another video. So, this is the end of our lesson on expansion and retracement. I hope you learned something. The first one we are going to be looking at is the expansion, and we'll also look at what retracement is. So, in part two, you are going to find what reversal and consolidation is, and also the assignment I gave yesterday. So, in this video, I'm just going to be talking about what expansion and what retracement is. So, mind you, all these four basic elements to a trade setup are just are totally controlled by the algorithm that I explained to you during the first week, which is the IPDA, interbank price delivery algorithm. Uh, at every point in time, price would always be doing one of these four things. In fact, it can't do two at a time. It will always be doing one at every point in time. Price can either be retracing or trying to give a reversal or trying to consolidate or consolidating or even expanding. So this particular algorithm can only do one of these four things at a time, and also at every given time, price the algorithm is doing just one of these. So in order for you to build a narrative around a trade setup, you must understand what price has done or what price is doing out of these four things and what can price do next based on the context. Sorry. So the context is what is going to give you the idea, or you putting up all the ideas of what price is likely going to do next. The narrative is just you understanding what price has already done. So the first one we'll be looking at is expansion, and the definition says expansion is the fast price movement away from a level of equilibrium. From our first week, I explained what dealing range is and what